Okay, so we're in chapter 6, and hopefully we'll finish up chapter 6 today. And we're going to go over reinsurance. Reinsurance, interesting topic. Okay, so reinsurance is an arrangement by which the primary insurer that initially writes the insurance, which means the primary insurance is the company that has contact with the customer. Okay. So the primary insurer then looks to transfer to another insurance company part or all of the potential losses associated with such insurance. Okay? So they look at the total exposure and decide, the primary insurance company, how much of that exposure they want to take and how much of it they want to transfer. All right, so this enables them to manage their portfolio of risk, okay, and it enables them to write more insurance. Because if they got a $2 million, in order to get a $2 million policy sold, they might only want $750,000 of that risk. So they're going to transfer $1,250,000. They're going to identify which risk and how much they want, and then they're going to transfer the rest of it to another insurance company, which frees their capital up to go out and get another account. All right. So the primary insurer is called the seeding company. We're going to seed or transfer some of the business. Okay. And the insurer that accepts is called the reinsurer. That accepts the transfer is the reinsurer. So there are insurance companies that are set up not to have contact with the end customer, but to have contact with the primary insurance companies. And it's the same thing in the medical industry. There are specialists who don't have contact with the primary customer until a referring physician sends that patient over to them. So the family practice doctor sees the patient and says, "This is beyond my pay grade. I'm going to send you over to see Dr. Riggs because this is something that he does all day long. This is all he does. And he's better at it, much better at it than I am." So Dr. Riggs knows that, and so he calls on Dr. Sloan and takes Dr. Sloan out for a steak dinner because Dr. Riggs knows that Dr. Sloan could refer that business to Dr. Garrett too. So that kind of marketing goes on. It's the same thing in the insurance business. All right. So the retention limit is the amount of insurance kept by the ceding company. How much of that risk do they want to take? And that's going to be in the the insurance policy guidelines. Okay? How large of a risk are we willing to take with one customer? So it helps them manage their portfolio. Okay? We don't need to know that. Session, whatever. Okay. A reinsurer, in turn, could transfer some of the risk. So the whole package is $2 million, and we saw that with Mr. Gentry the other day when he came to talk to us. He showed us how they sliced up a certain risk. Okay, so it's pretty cool. That's a pretty cool thing. We don't need retrocession. You can write that down, but I'm not going to ask you either session or retrocession on an exam. That's obscure. Whoops, what happened here? All right. So, reinsurance, as I said, is used to increase underwriting capacity. That means it gives an insurance company the ability to go out and find more customers. Customers that fit their guidelines. Okay? If they know that they can transfer some risk, then they can go take on more risk. So the primary insurer can write a larger policy knowing that they can transfer some of that risk. Okay? Reinsurance enables companies to get into multiple lines of insurance because they don't have to have as much capital in each area. So they can sell multiple lines. So you can see it's given them a lot of flexibility. Okay? And they know that if they're transferring a certain amount of risk, then they don't need capital reserved for the risk that they transfer. So it's a really important part of the industry. All right? Transferring that risk puts a limit on the losses that a company will have, an insurance company will have. Their worst exposures, the worst exposure is capped because they've transferred the other parts of the risk. Again, it's all about putting a lid, okay? And an insurance company might decide to exit a type of insurance that they've been selling because it's either, it just doesn't fit in with what they're doing for whatever reason. But they've written some policies, and so they transfer the risk on those policies so that they don't have to cancel any policies. The reinsurance companies will continue to cover the risk. Meanwhile, this company stops writing new policies. That's retiring from a line of business. They tried it for a few years and it just didn't work out for them. Okay. Okay. The reinsurance company has a lot of technical capabilities, resources, and so they can help an insurance company that has less experience writing a policy in certain industries, for certain industries. Whoops. All right, so these are all the things that a reinsurance, the function of reinsurance does for the primary insurance industry. And again, we looked at some very large reinsurers, and all they do is reinsurance. Everybody caught up? All right. All right. Two ways that reinsurance is written. Okay. The first is called facultative. Okay. And it's done on a case-by-case method. Okay, so the ceding company gets an application that exceeds the exposure that they're willing to take. Okay? And so on a case-by-case basis, they go to the reinsurance company and offer the opportunity for the reinsurance company to take on this case. Okay? So it gives them great flexibility. There are certain cases that they might want to keep for themselves, and certain cases that they may want to transfer some of the risk. But the reinsurance company, under facultative, the reinsurance company has no obligation to take that risk. Okay, so under this agreement, it's on a case-by-case basis. Both companies huddle up and decide if this is something that the reinsurer wants to take on. The other way is called treaty reinsurance. Treaty reinsurance. And this is an agreement that is struck up front whereby the primary insurer that initially writes the policy and the reinsurer agree upon terms of a certain type of risk or business that will be ceded. So it's less flexibility for the primary insurer, but there's more certainty for both companies that a certain amount of business is going to be transferred from the primary insurer to the reinsurer, okay? So, based on the agreement, everything that they agree on, a certain percentage, and we'll look at the two, there are two ways that the transfer is done, but the business is transferred over to the reinsurer, and the reinsurer accepts it. Okay, so less flexibility, more certainty. All right. All right, so let's take a look at how reinsurance is paid or structured. All right, methods for sharing losses. All right, pro rata method. So the ceding company and reinsurer agree to share losses and premiums based on a proportion, okay? So they agree up front what the percentage is going to be of the premium and of the losses, pro rata. Then there's the excess method. And the reinsurer will pay only when covered losses exceed a certain level. So with this method, the reinsurer and the primary insurer will always pay a certain percentage of losses. But under this method, the primary insurer says, I will cover losses up to $1 million. And then you'll cover losses, and this is what Gentry was talking about the other day, because the way they do it is there may be a $5 million total loss, and his company, Zurich, may take on the first $1 million, and they charge a pretty high premium for it, and then the next group takes on $1 million, and they may split that up two ways, and their premium is less because the likelihood of an excess above $1 million, of a loss above $1 million, is lower than the likelihood of the first $1 million, so their premiums are lower. And then finally, so that's $2 million, and finally somebody else takes on the $3 million that's way up here, and their premium's even lower. Their rate per million is lower. Okay? So you can have several different firms involved in writing this $5 million exposure. Yeah.
So whenever, like in this example, would the company pay the premium for like the $1 million that you split up there, or would it be like, let's say Apple is insured by like State Farm,
right?
And then State Farm gets Zurich to be the reinsurer. Would
Yeah.
State Farm pay the premium, or would Apple pay the premium to?
I'm sure that State Farm, Apple pays one premium to State Farm. State Farm negotiates the premiums with these guys, and then passes the premium along to Apple. And I'm sure that State Farm then pays the premium. So there may be a total premium of $100,000 a year. All right? And this $1 million here may be $50,000. And this $1 million here may be $30,000. And this $3 million here may be $20,000. Based on the odds that the loss will exceed $1 million, that the loss will exceed $2 million. So all that flows into, and Apple pays $100,000 to State Farm, which then divvies it up to these folks. Because you want to keep it as simple as possible. And so Apple really only wants to deal with State Farm, and they really only want to deal with one person at State Farm. Okay, we've had a loss, and the loss is $1,500,000. And we're not dealing with two people here and two people here. We're not going to do that. We just want to deal with one person here. Okay? And you do what you have to do to get all of it worked out. But we're having our own problems. We just had $1.5 million loss. We don't get it complicated by dealing with insurance companies and lawyers and things like that. It's called one throat to choke. All right. All right. So the reinsurer will cap how much loss they will cover. And so it all has to be pieced together. And you find that a lot in different areas of the financial services industry. Financial services is all about providing capital and managing losses, and it's done in banking. Okay, a company may come and say, we're building a new plant and it's going to cost $1 billion, and the bank says we don't have enough capital to fund a $1 billion loan, but we can put together a group of 10 banks that fund $100 million each. We can do it that way. That's called doing a syndicate loan. And same thing in investment banking, where a company says, I want to do a $1 billion stock offering, and Goldman Sachs says that exceeds our capital limit, but we can put together a group of investment banks. We'll be the lead underwriter on it, but we'll put together a group of 10 investment banks that will agree to buy $1 billion of stock from you, and then we'll all resell it to our clients. And it's the same thing. So all the companies in the financial services industry are involved in managing risk like that. Okay? All right. So there are different layers of risks that are agreed upon. The reinsurer, so the primary insurer has an insurance policy, guidelines about managing risk, and the reinsurer has the same thing. Okay? And you know, maybe the primary insurer is responsible to cover the entire, make sure that the entire amount is covered. Okay, so they tell Apple, we can do this. Okay, but what we're going to have to do is put together a group, and we'll take care of that. And so we're going to quote you. We're going to quote you $100,000 a year for a $5 million policy, and that's all you need to worry about. And Apple may go to Liberty and say, okay, I want a quote on a $5 million loss. Okay, and Liberty may go to these same reinsurance companies, or they may go to other reinsurance companies, and they may come back and say, we'll do it for $90,000. Okay, that's how it's done. And again, anything above 10 million, that's transferred to somebody. Somebody's covering it. Either the customer's going to cover it, or the primary is going to cover it, or another reinsurance company is going to cover it. Okay? All right. Okay, so a reinsurance pool is when insurance companies, instead of using reinsurance companies, the primary insurers get together, and together they underwrite an exposure. Okay, so instead of using reinsurance, it's a form of reinsurance. Okay, and again, it's about managing risk. And this is not in your notes, but they're typically formed to address unique and difficult to handle risks like natural catastrophes and terrorism. So, infrequent, difficult to predict risks that have large potential losses, the insurance companies will often get together and say, okay, we'll go ahead and underwrite this risk, but we're going to do it on a joint basis. It's just a different way of reinsuring. Okay? And it can be a group of privately owned insurance companies that come together to do this, or the government can step in and help backstop some of this with taxpayer money. Okay? And once again, it just increases the ability of the insurance company to take on risk and charge premiums. So pools work kind of like similar to reinsurance, where everyone agrees to pay for a percentage of every single loss, or its excess. Each pool member will cover a loss on their own below a certain amount, and then the excess will be covered by the reinsurance pool. Okay? So you're starting to see some of the creative ways business gets done. Okay? Business involves a lot of imagination, cutting deals that make sense. Pretty cool. I love the thought process that goes into it. All right. By the way, as I was walking out the door, I heard that Trump told the Republican leadership no more negotiating on a recovery package until after the election. So it's a negotiating tactic that he's using to put pressure on the Democrats to come to the table and pass a bill. So because the last recovery bill expired, and there are people out there who are hurting, and they couldn't agree on who was going to get what. And so Trump said, that's it, we're done talking, and now the Republicans are going to go back into the field in their races, and they're going to tell their constituents that they had a $1.5 billion bill that they were ready to move on, and the Democrats said no. It's a negotiating tactic, and we'll see what happens with it. To me, it's a very interesting way to go about it. I think we'll get a bill through now pretty quickly. Pelosi's never had to deal with anybody who's as hard-nosed as Trump. All right. Let's talk about the investments that insurance companies have. I flipped through to see if this is covered in some of the other chapters, and it really isn't. I was surprised. I thought that it was going to be in some of the other chapters, but let's take a look. So we've already talked about something that's really important in the property casualty business, something that I did not know until I read this book, and that is that the property casualty insurance industry breaks even on underwriting. They don't make